Hello and welcome. My name's Vicky Washay, and this is episode 103 of a Wealthy Life podcast. Today, I'm going to be joined by Sean, the property tax guy. We are very lucky to have us with him. Now, much like some other guests, he prefers to keep his face off of YouTube, but you will be able to listen to the podcast on iTunes and on Spotify, of course. But what we've done is we've also added a link here in YouTube so that you can come at it that direction. So however you want to do it, you need to make sure that you listen to this episode. This is property top tax tips. That's a proper tongue twister. However, we are keeping it simple, and Sean is going to explain everything from how you make sure that you get the right tax accountant in the first place to how you work with them and can be the best possible client for them, and how that can save you a lot of money. And I think that's the bottom line here. If you listen to this podcast, it will save you money, it will save you time, and it will save you stress. And those are all the things that a wealthy life is about, making sure that you use your money in the right place, so that you have plenty of time and no stress in your life. Let's get on with it and welcome Sean to the podcast. Hello and welcome. My name is Vicky Washay, and with me today, I have waited so long for this guest. He is a hard man to get hold of. This is Sean, the property tax accountant, and we are very honoured to have him on A Wealthy Life today. So Sean is an expert. Obviously, he's an accountant. Obviously, he's a tax accountant because it says it in the name. Obviously, he's about property, but what he is also about is working with expats. Now, whether you're an expat or not an expat, i.e. somebody British living in another country, you are going to get masses of value out of this podcast and then the next one that we're going to record, which will be released a little bit later. So first of all, welcome, Sean.
Thank you very much, Vicky. That was a very, very warm welcome. I very much appreciate it.
Yeah, I've waited so long for you. I'm delighted to have you here and being able to speak to you on the podcast. So my problem with accountants, lovely people, I'm absolutely sure, and obviously you're a lovely person, is that the very first one I used, for example, is we would get to the end of the year and they would say, send me your papers. And because I quite like a spreadsheet, at least things were on a spreadsheet, and things were in those days when you had to keep paper of everything was in a folder with dividers that said all of the months, and I would send that all to him. And then there would be this panic, usually around between Christmas and New Year or New Year, just when you're offline and you're trying to relax and they're coming back at you with questions. And we sort of had these mini panics all through January. And then finally, at the end of January, because there was this deadline, the 31st, everything had to be submitted in England. So he'd submit stuff, and then I'd get the papers, and it would have said to me, for example, that my mileage expenditure was really high, or my meals out, or my hotels, or some part of my expenditure was out, and then my profit was down. But I worked out that what he was telling me in January, if you like, of year one was what I'd been doing in April minus year two to March minus year one. And there was nothing that I could do about it. And I'm sure I'm not alone in having that experience with an accountant. There's got to be a better way. So given that, here I'm going to try and say the title, this podcast is all about your top tax tips. What would you suggest that, let's start right at the basics. How is there a better way for people to have a relationship with their accountant and tax accountant?
Well, congratulations on getting the tongue twister right anyway to start with. So that's excellent. Right. This is such a common problem. I would like to say, or would like to think at least, this is becoming less of a problem over the years for a multitude of reasons, but it's certainly not a problem that I would like to think that my clients have with me. Generally speaking, personal tax returns with my clients, they're all normally done by about July of August. We're not waiting for that January crunch. If there's a reason for that, it's just because my clients maybe have been a little bit delayed or hesitant in sending records to me. But let's answer your question properly. HMRC actually tried to resolve this problem for their purpose, and they tried to implement Making Tax Digital, which has largely been shelved. What Making Tax Digital was going to do would be force taxpayers to do quarterly reporting to HMRC, depending on the type of taxpayer that you are. But regardless of that, regardless of the fact that HMRC have shelved Making Tax Digital, all of those good things that HMRC were doing, the newer breed or more modern accountants have been doing for several years now. And really that was utilizing the advent of cloud accounting. So what I do, for example, with my clients is I use QuickBooks. Other accountants use Xero. They tend to be the two most popular in this sort of space. We hook up the business bank accounts to that accounting system. We do the bookkeeping on a real-time basis, issue management accounts on a periodic basis as well, be that monthly or quarterly, depending on the client's needs. So that means within a few days of the end of each month or quarter, you as the taxpayer, you as the client are receiving a set of management accounts. And then if you've got more of, say, a complex or maybe a volatile business, you can have that regular call with your accountant. You can go through your business and say, look, it appears that this is happening. Tell me about this. What's going on? What are you planning to do next? And how can I help you do work out the best way of approaching that? And it really makes it that it creates that wonderful team between the accountant, the professional advisor, and the client. That's the way of doing these things. Yep, you might be paying a little bit more for it, but that's where you get the value, you get the support for your business, you get the savings through tax, because you know what, once you've either made a transaction or worse, not made a transaction within the tax year, you can't go back and fictitiously make up a transaction. Whereas real time, I could be saying to my clients, say if they're operating a limited company, is make sure you charge them expenses for director trivial benefits. Once the end of the accounting period is ended, I can't tell them to do that. If they want to run it through their business bank account, there might be other ways, but regardless, that's the way of solving it. It really is. The way you're describing is so 1990s. It really is. It shouldn't be like that anymore.
The problem is that there are people who have almost like familial family style relationships with their accountant, that they have been around so long that they've worked with them for 10 years or for 12 years. And if they are, let's refer to them as the more dinosaur style, they could be digital, but they could still be in the dinosaur mode of thinking, that it's actually difficult for you to know that your accountant isn't a more modern thinking accountant, even if you have switched over to doing things, as you say, with all this cloud accounting. I've certainly switched over. And it's interesting, isn't it? What about the thought between, so I work with somebody who, in one sense, she does all my bookkeeping, but she's qualified up to being almost an accountant, but because she's in a different country, she can't perform as an accountant. Mm-hmm. So she hasn't transferred her account, so her qualifications and stuff. So she's got all of those skills, and we have those conversations, and we do things quarterly, and then we send them over to the tax accountant that finalizes them off at the other end. Mainly again because my accountant's very busy, and trying to get in with them as well is quite a challenge to have the length of conversations where I can have conversations with somebody who, without being rude, I'm sure you speak English, not just the words that come out of your mouth, but mm-hmm. So many accountants speak accountant and they don't speak English. The accountants that I had between my dinosaur and between the one I've got now, I used to have someone come as a translator. So the woman would come who's done the accounts, and she would speak to me, and I go, I don't know what you've said to me. I don't know what that means. And then the person who was sitting there would go, she said you made a profit. And she just it just didn't, she was really good, but she just could not speak in a way that helped me. And I think that's what we need in an accountant or a bookkeeper accountant combo, however you do it, is you are actually one of the most important parts of the team. If you're in property, you've got your solicitors as well, but while the solicitor's taking care for the legals, if you haven't helped me know whether I'm making a profit, whether I've got tax liabilities, and we could get into all the different sorts of taxes that could affect us. I could be doing everything legally, but actually not making any money at the other end of it. Or worse, face a massive tax bill thinking that I've made money and then end up with nothing in the bank account.
It is very, very difficult. And it happens in all industries as well. I mean, I love to invest in property, but you put me in direct contact with a roofer and he's using all of these technical terms that I don't know. So there's a few things or a few tips that I might provide here is number one, it's all about selection in the first place and making sure that you have, well, first off, even before you get to the selection stage, you've got to know that you have a problem and the way in which you find that out, because you don't know what's, you don't know what you don't know. And the way of finding these things out is that you perhaps not being served as well as you could is by listening to podcasts such as this. It highlights these issues. So then once you recognize that you do have that challenge, you can either ask your accountant perhaps to behave in a little bit of a different way. I think it's about education yourself. So maybe it's a case of listening to these podcasts, going onto YouTube. If I needed to talk to a roofer, I might start Googling the hell out of, roof leaks and things like that, and eventually find a few YouTube channels that at least can have a basic conversation with that roofer and know whether I'm going to be ripped off or not when they're sucking in the air through the teeth. But then it might be the case that you have an accountant that's you're just no longer perhaps a good fit, and therefore it's then a case of perhaps interviewing several different accountants, finding them through recommendation and referrals from other people that like and trust, and then interviewing them, quite frankly, and asking lots of questions. How do they behave in certain circumstances? What can they get them to talk through some examples? And if you find that you are speaking the same language and they can adjust to your level of base knowledge, then perhaps they are a good accountant for you. I'm pretty sure on either a blog post or newsletter that I released, it was how to find the right accountant, and it covers aspects such as this.
Awesome. We'll see if we can find that link and put it in the show notes. What do you think of the accountants now, and I don't know whether you do, that charge a monthly fee? So it's like you're almost a membership, or there's a retainer, and so they're charging a monthly fee for these things, whereas other accountants will say, okay, to do your accounts cost X at the amount of the year. I mean, is there any differences there that we should be aware of?
That is definitely the direction that most accountants, at least the smaller firms and sole practitioners, are moving towards. And in fact, there's accountancy coaches as well. There's not just property coaches or wealth management coaches. There's accounting coaches, and that's definitely the direction that they are pushing at the moment for regular compliance work. There's a number of advantages to this. If you take the old-fashioned model, where a good example is the one that you just described, actually, is where your accountant would just do your tax return at the end of the year. You wouldn't speak to them for the rest of the year at all. It was all rather rushed in January. You're getting little to no value out of that, other than the fact that your tax return is being filed and they're telling you what your tax is. What I tend to find in that way of doing things, where it's just a set fee, is you get to the end of the year and then your client might say, oh, I've done this or I've done that. And inside you're feeling a little bit horrified, because had they picked up the phone to you or booked in a call or shot you an email, you'd say, don't do it that way. Please, please, please don't do it that way. Do it this way instead. And you'll save yourself thousands in tax, sake of a 5-minute call. And so therefore you want that accountant on hand that not only, as I described earlier, is doing all your accounts on a real-time basis, so that that accountant exactly knows what your financial position and performance is at that moment in time, but also have a good understanding of your business. And what I've tended to find where I've picked up, say, a new client that says, well, let me take a step back here, is I offer a number of different packages. The most basic one that some of my clients go for, it is just your basics, do your tax return. I'll still absolutely do all the management accounts on a quarterly basis, as long as they're using one of my accounting systems, absolutely. But they don't get that additional contact with me during the year. But that's something that they would prefer to do, so that they're paying a lower amount per month. The majority of my clients, probably 80%, will go on to a different package where they can pick up the phone anytime, hit a link on my website or in my email signature, book a call with me. They're speaking to me very, very soon. And the reason why you'll find it so difficult to get hold of me is because I always prioritize, being accessible to my clients and block all of that time out.
Of course.
And so by having that comfort that you can speak to your accountant at any time makes a huge amount of difference, because you're getting real-time support. It's so important. What it does mean from an accountant's perspective is, of course, they need to block out that time for you. There's naturally a cost to that. So rather than doing hundreds of tax returns each year, it might be just less than 100, but you're providing that service continuously for your clients. I also tend to find that for the clients that, same example really, for the clients that go for that lower package without that additional help and support, and they recognize that, if I need to pick up the phone, it will, just be paying at the normal hourly rate. They want to have a quick call, they defer having the call, and then they speak to their mate down at the pub instead. And you get to that same situation again, where they've made a mistake. It would have taken 5 minutes to resolve. Going with that second package, you get such a much nicer relationship with the clients as well. It's just nice from that perspective.
And I think that takes us back to that idea of interviewing someone, because you're going to have a relationship with this person, you and the client, but also the client and their accountant. And again, if you're going to pick this monthly paying, then you want something during the year. Don't pay monthly and only ever speak to them at the end of the year. Make sure that you've got maybe a quarterly meeting in. If you're only a small business, maybe just speaking quarterly for half an hour. You've had the paperwork, you think about what questions you want to ask. Your accountant says, yeah, you're doing really well, or you're hitting all the goals that we had. So I have a business plan as well that projects what I think I want to do for the year. And I can change that as I go throughout the year and then share that back. But then when I have my conversations, they're going, you're running a bit low, or you're running a bit fast, or your expenses are a bit high and your income isn't quite where it should be. And they can flag up where there are those missing targets. That I can see if I've hit the targets, but I want them to pick up, why have I not hit the target? Because sometimes I could be working really hard and I've taken my eye off the expenses. And it's always that thing, isn't it? It's the combination of income and expenses and targets and conversations that are so important.
It really, really is. And I'll give you an example from an accountant's perspective. If as an accountant, I want to adopt that model where I am part of, I don't like the term, but it's a little bit cheesy, I'm part of that power team for, say, a property investor, along with the mortgage broker and solicitor and everybody else. I want to feel as part of that team that I am adding value. And over the years, I have had clients whereby I've actually contacted them and their husband or wife and just said, is so-and-so still alive? I haven't heard from them for 6 months. They've not responded to a single email. I'm quite concerned about their well-being. That type of client is not an ideal client for me. I want to work with somebody that is responsive also, whereby if we get into a brilliant routine where, over the course of the month or the quarter, I prepare their accounts, we have that conversation, I deliver the accounts to them, we go through it, and then you can provide that value. The risk to me is if I don't hear from a client for a long time, and my concern is that I don't actually fully understand their business, Therefore, I'm preparing their accounts with incomplete information. Accounts are not just about the numbers. There's other stuff that you might need to account for that, you know, doesn't necessarily relate to a bank transaction. And I want to make sure that whatever I deliver is correct. And that's exactly what a good accountant does. And they will strive to create that excellent working relationship, because that's what it is at the end of the day. You're part of the team.
So you sort of said there that in order for you to do a good job, it's like we have to do a good job. And what can we do better to make it easier for you to do your job? And I suppose really the question is about accounting, so bookkeeping. So if we're going to do everything online now, and you've linked my business bank account into either QuickBooks or Xero, what else do I need to do to make things easier for you?
Just be responsive and I hate to put it this way, but just follow instruction. A lot of people, I understand why this is, will bury their head in the sand and you know, say this is a problem for, you know, future me, tomorrow's me, and tomorrow's me never actually arrives. So I mean, the key thing will be is as you've already provided a couple of examples there, you know, one of the biggest things that you can do for saving tax, this is one of the top tax tips, which is simple, is just maintaining good records. And so whether you are using a proper accounting system or not, whether that's spreadsheets, whether that is the likes of QuickBooks or Xero, I definitely recommend, you know, using the accounting system. It makes life easier for everybody, full visibility for both parties. Connecting that bank account, making sure that the accounts are being done on a near real-time basis to provide that management information. It's asking questions to the accountant to say, look, I don't understand this. What are you talking about? What do you mean when you say this? What does a profit and loss account show me? How should I be looking at it? What's a balance sheet telling me? Important again with property, what's a balance sheet not telling me? So the balance sheet might not tell you the today's value of a property, and it just tells you what you bought it for 10 years ago, perhaps. Again, that's really important for example, those investors that are seeking angel finance, as an example, because they might say, here's my balance sheet, doesn't look good. And then the new investor might say, well, hold on a minute, your mortgage is greater than the value of the properties on the balance sheet. It's like, oh yeah, that doesn't make sense, but there's a reason for that. So there's that, and then there's even just little things. For example, this is perhaps getting a little bit too far. I've got a couple of dream clients, and what they do is they have a separate bank account for each and every property that they own. So a bit of an admin headache, and I'm sure their wallets are very fat with lots of different cards, but it makes life wonderful. They know in real time how each particular property is cash flowing, because they can see the bank account. It makes my life easier because I know exactly which expenses or income to assign to each property. So that way, when I provide them with management accounts that show them their real profitability by property, they've got all the information that they need. So they can see which properties are performing, which properties are not performing. Right, I'm going to do something about those properties that are not. That might mean selling, it might mean doing something else. But even just things like maintaining good books and records, that's where you're going to get the majority of your tax savings. The people that don't get the tax savings are the people that do their tax returns in January. Exactly what you said at the start of this call actually is they can't remember what they spent 18 months ago. No. So therefore you don't include that expense in your accounts, and then suddenly you have a bigger tax bill unnecessarily.
So I've got two questions out of that bit that come up. So one is how you're keeping the accounts, and the other is bank accounts. So the bank account thing I think is quite a simple one to you and me, but I very definitely, I've got a very experienced investor that works with me, and they still keep everything in one account, and it just makes me go, what else is going on? Number one rule has to be, whether it's limited or private, and we're going to do the whole podcast on the pros and cons of that later, because that's quite a minefield. So just keeping it simple for a minute, you've got a property, or any other business, quite frankly, if you're listening and you're not into property, you've got you've got a property, which to my mind is a business. It should have its own bank account, and you don't buy your cinema tickets and your Sainsbury's or Tesco shopping out of there. But what you do is you put the roofer's bill in there, you put your EPC in there, and that's all that is in that account. The rent coming in, the mortgage going out, and then the insurance and any expenses on a monthly basis. That's right, isn't it?
Absolutely. You must not mix business and pleasure. Yes, from HMRC's perspective, if you are a landlord that owns property in your own name, they will see you and the business as one. Very different to a limited company where it's completely separate. But absolutely, you must use a separate bank account. Otherwise, both you and your accountant are going to be pulling your hair out. In fact, what you've now done is created a ton more transactions for your accountant to sift through when they're doing doing the bookkeeping, and you'll pay more for that. So you're paying extra fees just because you didn't take the time to open up a separate bank account. And again, this is another one of those ostrich moments, really, is people think, I'm going to open up that bank account tomorrow, and tomorrow never comes. And then they realize why they're paying more tax or more accountancy fees than they need to.
Exactly. So then the other thing is, I mentioned it right at the beginning. In the old days, I used to keep, and I still, I'm a nightmare for keeping all of these pieces of paper. I used to file them all in a lever arch file with the dividers in the old fashioned way and the plastic sleeves, and spend hours doing all of that stuff. And now it's so much easier. I scan it and I put it on WhatsApp, and the bookkeeper takes it and put it into Dropbox. Right. And I suppose I could do that myself, but it's just easier to take a photograph and let her do it. Do you suggest, if people have the skills, that they could be doing one of two other things? So yes, you could take a photograph and send it. 2, you could enter it into a spreadsheet as well. I think that's a bit of extra work. Or 3, do some of your clients actually directly enter these expenses? So for example, here's the roofer's invoice. They go to QuickBook or to Xero and actually enter it as a cost themselves into the software.
It's even more simple than that these days, than all 3 options that you just described. First off, keeping them in a box. You won't even be able to read that receipt in 2 or 3 years' time because the ink would have worn away. And that's no good for HMRC when you have to dig out those records when they want to come and do an investigation. So the way in which QuickBooks works and Xero, I think it's Xero and Dext, I think is the product, that do it the same way. I'm a QuickBooks user, so that's what I tend to speak about. If your roofer sends you an email containing an invoice, all you'll do is just forward that email to a specific QuickBooks email address that your accountant will issue you with. So that might be vicky@qbodocs.com or something. You'll just hit send. All you have to do is hit forward, put in that email address, hit send. That is your job done.
Nice.
You need to do nothing more than that. Alternatively, if your roofer gives you a paper invoice or receipt, you will open up the QuickBooks app on your mobile phone. You'll snap a picture of it, and that's it. You're done. Then me, as the accountant and performing the bookkeeping, I will log on to it, and then that transaction will come through the bank account, that £1,000 or so that you've paid to your roofer. QuickBooks, probably 6 times out of 10, it will recognize, it will do text recognition on that invoice and match the 2 up. And it will say, it will give me an option to say match, and I'll have a look at the invoice and have a look at the amount on the bank feed and go, yep, they match up, code it. That's it, done.
Job done.
And then the same with the paper invoices as well. So yeah, but the number of people that don't do that is probably 95%. So,
well, but I've
even
just
though it's so
something.
easy.
Yeah, I've just learned something for you about the email forwarding and the app, and I'm definitely going to go and see if Xero offer that as well. I had one very, very tech-savvy investor way back in 2015, so a good while ago now. And I think it was called Evergreen, and he had the same thing where he could just photograph everything with Evergreen, and Evergreen would recognize what it is and say, is this a petrol receipt? Is this this receipt? Is that? And you created the folders that you wanted all of these different receipts to go into, or even if you wrote notes, as long as you took a thing at the top, and let's say I had podcast meeting notes, so things I thought about to speak to you, it would go, do you want me to file this in podcast? And it looks like they very cleverly put these two things together with the text recognition software. So that's awesome. Yeah, love that. So we are interviewed, we like one another, we've agreed to the level of service, we've agreed to the cloud. I now know the best way to send you my side of things. Let's just keep with sort of the paperwork side of things for a minute and go with, what about travel expenses? Is this claiming petrol or mileage and petrol? How best, and can we claim? I mean, I live in Surrey and travel to Liverpool a lot and all over the country.
Again, there's a couple of ways of doing this, and it really depends on the volume of to which you're traveling. So first off, let's start from the start here. Is that you can travel, you can claim business mileage as a tax deduction. So that's number one. Your options in that respect are either claiming the petrol. That is tricky because you fill your tank up and you spend your whatever it costs to fill a tank up these days, £70 or whatever it might be, but it's difficult to track. Did I use that full tank? Did I use a quarter of a tank to do the journey? So I would not recommend that. What I generally recommend to all of my clients is actually do it on a mileage basis instead. What trips you've done, and then you can claim the 45p allowance that HMRC allow. Now that mileage allowance is more than the cost per mile of petrol, and it should theoretically cover wear and tear and insurance and things like that. Now, quite frankly, they've not increased that rate for years and years and years. I think it was 40p a mile back in the year 2000 or 2002, and so they've moved it 5p in the last 20-25 years. But regardless, it is still more cost effective than just charging petrol, and easier as well. If you're just doing a few trips to a handful of properties per year to do a bit of an inspection or go and visit them or do a little bit of repairs, then I would say just keep a spreadsheet. I'd provide my clients with a template at the start of the year and just say, use this as a log. I'll do all the calculations for you. You just need to tell me what the mileage was, what the purpose of the visit was, from to, and then if you had a passenger in the car that was part of your business trip, you can claim a little bit more on top of that.
Oh.
However, if you're doing a lot of mileage, and typically if you're going back and forth every day, then what you can actually use is the QuickBooks app, and it has a GPS tracker on, and you can just go into the app, start journey, finish journey. It will measure all of your mileage, so you don't have to work out, well, I did 15 miles to B&Q and then 25 miles to the property, and this was the purpose. You can just do it all in the app. It'll just track it in the background using GPS. The problem with that is most people tend to forget to switch it on and off, and then end up tracking a lot of personal mileage. So kind of defeats the object. And then you do find then there's others, for example, that they might use a van solely for business purposes, and then it makes sense just to claim the petrol, the insurance, everything, directly.
And that's quite interesting, isn't it? Because that brings in personal versus not personal. So, for example, with the mileage, I can claim going to view the properties, but I need to make sure that I'm not claiming when I go to do my shopping, which is why we're claiming the mileage. What's the thoughts on your mobiles then? And even Wi-Fi, and I suppose this brings into working from home expenses. So do we need to have two mobile phones? How do we work the Wi-Fi? So if you're at home and the kids are using it and they're downloading things there, but you're using it in the home office, how do you handle all of the home office side of stuff?
Yeah, but there's different ways of doing it, and it depends on whether you're operating from a company or working under as a sole trader under your, if it's personally owned property as an example. But generally speaking, the expenses that you can claim are a share of what the house is using. This is a very general rule here. So, don't take this as, well, in fact, take none of what I say on this podcast as tax or business advice, because I always have to tailor it to specific individuals' facts and circumstances. So I should have done that caveat at the start, but
yeah. We'll
regardless,
make sure that we put that on. But I mean, it's obvious. All we're doing is we're talking. If you hear anything here that you're unaware of, you need to take it away and check it. So
exactly, yeah. So, so what's the best way of talking through this one then? So first off, let's say you have a home office, you have your spare bedroom, and you pop in a desk there. And so it has a bed, a desk, say you're using 50% of the room, and let's say you're using 10% of the time available for that room. So what you would do is you do a calculation based on the number of rooms in the house, excluding hallways and kitchens and bathrooms. You say, well, I have, let's say I have 4 rooms in my house, and one is the spare bedroom. And so that makes 1/8, so half of 1/4. And then I'm using that for 10% of the time. So you do 1/8 times 10% of the time used in that room, multiplied by the expenses of running that room in your house, or the house. Sorry, let me phrase that a different way. Of the total expenses for the house. So that would include things like electricity, gas, water, and anything to heat it, all of those things. And you could put through that proportion through the accounts. You have to be a little bit careful with things like internet, because HMRC will assume that, well, you're going to incur those expenses regardless. It has to be something incremental specifically for the business. So perhaps what you might have done is you had one internet package for the home, but then recognize you're going to be doing a lot of work from home. You needed to increase your bandwidth. So maybe that incremental you could do separately. Or alternatively, phone lines used to be the old-fashioned landlines. That was a good one. The landline, you couldn't necessarily put a share of the expense through, but what you could instead do is install a second line and put 100% of that cost through. So those are the types of approaches that you would do. For things like mobiles, again, what you'll want to do is analyze what's business versus personal use. So, and again, this can be done on a time apportioned, reasonable basis. Now, of course, if you're still, on one of those packages where you do pay for calls, then the expectation would be you go through your phone bill and look at all the cost of those calls. But most people, exactly, that was kind of the old school way of doing it. I mean, most people, they don't spend a lot of time on the phone these days. They're doing emails. They're maybe managing the social media for their business. And so it's really about data usage and proportion of time using your phone. So if you think that, you're using your phone 50% personal, 50% business, and you have, a decent enough sized business to warrant that, then that's absolutely fine. The key thing here is it reasonable? Is it something that HMRC would find as reasonable? Could you defend it if an inspector was asking you about it? What is it that your peers are doing? I mean, ultimately, what HMRC will do is when they're reviewing your tax return, they've got the software and the artificial intelligence to be able to review all, thousands of property investors. And if they see yours as a complete outlier in terms of the expenses that you're charging relative to everybody else, well, who are they going to pick to do an investigation? You want to stay below the radar, really. You want to make sure that you're getting, as many of those tax deductions as possible without putting your head above the parapet. So
that's a really interesting bit. Sorry, that idea that over there at HMRC, with all the clever stuff that's going on and AI and spiders and everything else that are words associated with computers, they're looking for the norms. And I remember in maths, that whole bell curve, you stay within the bell curve. If you're an outlier, probably if you're claiming less tax, they probably won't care about you. But if you're claiming too much, that's what's going to flag up. And therefore, always to ask yourself, is this the norm? Is this reasonable? And also just think about yourself over the years. You know, if you've been poodling along and you claim this, you claim this, you claim this, and then all of a sudden, say, for example, the home costs, because we've been talking about that, they suddenly shoot up. Why have they shot up? So in recent years, it could be because all of a sudden the cost of fuel, you know, to heat the home has gone up. They could drop, like we've put in solar panels. And I think our heating bills at the moment are £25 a month for gas and electric, which is nothing. I mean, prior to putting this in, we were in excess of, you know, 150 a month. So we've gone to the other side of the bell curve for the minute. But to look at that, and it could be that you can explain it with, I only had 3 properties and they were in one location close to home, and now I've got 20 properties. I've also got an assistant that sits in the room with me, and you know, I drive to this location and to that location. So if you can explain it, then it's fine. If you can't explain it and you think that you are unusual, have that conversation then, because we're going to have this relationship.
Yeah, can you sleep at night? And that's often my approach. I mean, yeah, I've had clients that said, I'm claiming for this, I'm claiming for that, or want to claim for that. You know, my friend down the pub is claiming this, and I say, the line is grey. There's not a hard line, and HMRC, despite, you know, service levels dropping, all of those things, they do have some pretty powerful tools at the hand. And as we're saying, I love the bell curve you know, idea that you brought there. That's exactly it, is stay within the bell curve. I mean, there's all sorts of things that HMRC have to its hands that, you know, you might not automatically assume that they can do. So for example, you know, they know, they have access, of course, to Her Majesty's Land Registry, for example, so they know who owns which properties, and if they're not seeing those properties declared on tax returns, they are, you know, getting information from Airbnb as an example of who's letting out properties on a short-term basis. If you're I don't know, let's say you're an expat and you're registered as non-resident for tax purposes in the UK, HMRC are getting all of the border control information. So every time you go in and out of Heathrow or whichever airport, that's going to HMRC. So when you put in the number of days that you've spent in the UK, and, you know, try to say that it's less than 90, for example, but they know that you've actually been in the UK an awful lot longer. Again, there's those sort of things that are happening in the background. You absolutely do not want to be, you know, misleading HMRC, tax evasion, and you also just want to stay within the norms. So I mean, my approach with my clients is let's keep them safe above all. Let's make sure that they do claim things but don't go over the top. You're far better to claim, you know, making it up, 16 different allowances rather than going hard on one.
Yes, nice. And I just was thinking, as you were saying all of that, there might be a few people going at the other end going, yes, yeah, okay, you know, whether you're expat or not expat, or maybe I am trying to claim a bit too much. Well, while we're scaring the life out of people, we probably shouldn't even discuss this, because this shouldn't even be a thing, but paying cash for things rather than getting an invoice and paying the VAT, and thinking, because it's annoying, isn't it? Just sticking with the property example for a minute, that idea that if the house is derelict, then maybe you don't have to pay VAT, or some things you can pay 5%, but other things, and 20% feels like so much VAT. And so if you get offered the opportunity to save 20% on anything, given that your whole business in property is all about getting a discount on stuff, the temptation is there. I don't even need to ask you what your thought is, because I would assume, as an accountant, and you should never assume, is that you're going to say pay the VAT. I don't think the question is even why, but there's obviously a point here over and above the obvious of you should pay the VAT.
Absolutely, yes. So, I mean, first off, you don't want to be facilitating tax evasion, because if a supplier is saying, hey, I'll discount for cash, that means they're not paying income tax, VAT. And, you know, if you know, we were, you know, on the left of the political spectrum. That means, that money is not going towards, hospitals and the like. But whether you are left or right leaning in any regard, let's not make this episode political. You potentially could end up just storing up a bigger problem for yourself. It's a little bit like the books and records item I mentioned earlier. Is where people end up paying more tax than they need. Is where they don't have evidence of certain transactions that they have paid for, and because they don't have evidence of that expense, they end up paying a lot more tax. So take for example, if the contractor says to you 10% discount for cash, if you're a basic rate taxpayer, then you're going to be paying, say, 20%. You'll be paying more in income tax. Assume you own the property personally and you're a basic rate taxpayer, your tax deduction for some repairs and maintenance is 20%. If you're a higher rate, it's 40%. So straight off, you could actually be paying more. It's just a question of when you're going to be paying it. Is it today when you've got to pay the roofer, or is it in a year's time when you're having to pay your tax bill? You could actually be paying more. And then let's not forget, you want those, the 10% saving on a 20 grand refurb that you're doing. Yes, the refurb, you're not going to get that immediate tax deduction, depending on the type of refurb, because it's generally a capital expense. But you will come to sell that property at some point, or your children will. And what they'll want to see is well, how much was that refurb? Because that will offset your capital gains tax. And if you're a high rate taxpayer, you can be paying 28% in capital gains tax on that. So there's both, moral, ethical, and financial reasons of doing it. And also as well is I tend to feel, I think you mentioned the spider approach with HMRC is what you'll tend to find is that when HMRC do an investigation, they find a bad actor, and then they find out who that bad actor has then been working with. And you don't want to be caught in that situation. You want to be able to say, hey, I've this is everything I paid for. Everything matches my bank account, but invoices and receipts to support it. I'm going to sleep really well at night.
Yeah, I think that's a really important thing, isn't it? Whether it's in your private name or whether it's in a company, this is a business. And those invoices aren't just about what you've paid today, but they have those tax implications, and to think of that. So we've been talking for ages, and I'm very aware of your time, having been so lucky to get some of it. So let's just sort of wrap up with a couple of other things which are a bit more complicated, and we're going to do the big stuff in the next podcast, which is directors' loans. So we've had a situation at the moment where we've just heard about someone through other circumstances that I won't go into, who has been drawing money out of the business on a director's loan. And when we queried this, they turned around and said, well, that was our wages. And so they've taken money out on a director's loan and taken that money personally, and then not been taking a wage, which means they've not been paying income tax and not been paying national insurance. So so the thing with the director's loan is you can either lend your company money, and therefore if you're making a loan to the company, you should get interest on it. So there's a bit there to speak about. But also, if your company has made a lot of money and has got profit cash sitting in the account, you can do things with that. And we'll talk about that maybe transferring out into other companies afterwards. But talk a bit about the whole uses of a director's loan.
Yes, it's a relatively complicated area, but I think that the risk that you're really getting to there is what's known as an overdrawn director loan account, and this is a situation that really should be avoided. Every now and again, I do get a client that goes down this route, and it's just naivety, but then it's a real effort to try and solve the problem from both parties' perspective. So is
that bad form in terms of, so just briefly there, because other people might borrow money from their DLA, their director's loan account. If you are in a limited company, because obviously the director's loan relates only to people who've got limited companies, because you can't have personal DLA. So in your limited company, if you have been taking money out of the business, and as you've used the term, it's an overdrawn director's loan account, is that bad practice as a director to run a business in that form?
Yes, an overdrawn director loan account is bad practice. Yeah,
okay,
absolutely.
So let's just say don't
it's
do
not
that.
illegal. Then. It's not illegal, but it's
No.
bad practice,
Okay.
and it's highly tax inefficient. And so let's just go. Let's for in case people aren't familiar with director loan accounts, let's just take this from first principles. First off, a director, if they're setting up a new company, they're likely to want to put some funds into the company. They can either do that as share capital or as a director loan. A director loan is 9 times out of 10 for at least small property businesses is the most tax efficient way of doing things, particularly if you're buying a property. Say if you buy a property for £100,000, you get a 75 grand mortgage, and then you put in the other 25 grand yourself. You put that 25 grand into the company as a director loan, and then the company will have to repay that loan to you, the director, at some point in the future. And it really just depends on you must put in a director loan agreement, and that sets out the terms of repayments and what will happen in the circumstances of default, etc. So that's absolutely fine. So what typically will happen in that situation is, as the company begins to have positive cash flows, starts to generate profits, etc., then unless the directors of the company decide to invest in additional properties, for example, they might say, well, we've got this spare cash, so let's start paying down the director loan account. So those repayments of that loan, absolutely fine. It's encouraged, it's good. That's exactly what a loan is. It's a loan that has to be repaid at some point in the future. So you pay back that 25 grand. There's now no loan remaining. Great, everything's clean, wonderful, good situation. The problem then is if that company is continuing to have profits, the positive cash flows, and then the director starts to just take money out of the company beyond the original amount that they originally lent to the company. That's now in the situation where the loan is now overdrawn. They're in an overdrawn position. What they should have actually done is either taken a salary or taken dividends from the company if they wanted the cash out of the company. Both of which sounds a little bit like a headache. So they just need the cash tomorrow. They've got the bill. They've got to pay their own personal mortgage or pay for a holiday or whatever it might be. So they take it out. The problem with an overdrawn loan account is the way HMRC view that is well, that is actually income that director has had. However, they can't charge the individual director for that income. So instead levy the tax on the on the company itself, and so the rates are over 30% that they'll charge. The company will have to pay corporation tax on that overdrawn loan account. There's lots of complications here, and whether it's over and above a 10 grand threshold and all of these things. But worst case scenario here is that the company has to pay corporation tax on that loan at 33.75% until that loan is repaid. But the problem is that you will only get the refund on that tax when the loan is repaid. Something full. Like in full, 9 months after that the tax return has been filed, or after the year end, should I say?
Yeah.
So you could be paying a lot of tax and then not getting the refund on that tax for a long, long time. So it's horrendous for cash flows. It's horrendous for tax charges, and it could have just been dealt with through just by declaring a dividend.
And I think there's some interesting things there, isn't it? Which again is back to pure maths and having the conversation with your accountant, because people will be going, for example, think about income tax. Well, I already earn, let's say, £40,000. I don't want to take any more money out of the business through my personal account, because then I have to pay high rate tax. Well, hold on a second. You're going to pay your lower rate tax. First of all, you've got a tax-free amount. Then you're going to pay tax between the tax-free amount and the 45, I think we're at the moment. Only when you pass that threshold into higher rate tax, you only pay you only pay 40% on the other bit. And when you sort of apportion it across, it's a lot less anyway. But then the other thing is, for example, with dividends, they used to be nice, didn't they? And that you could take £5,000 out, and that's down and down and down. But you've got to have that conversation before you take the money out. And if you've got this relationship with your accountant, you go, do you know what? I've got a lot of money sitting in my account. I've got 10 grand, 20 grand, however much I've got sitting in my company account. And, I really want to go off on a round the world cruise for my 50th or whatever. Please, can you tell me how best I could take it out? You know whether I've got a job or not a job, my income tax situation. Give me the advice. That's your job. And I just need to ask that question. I had a celebrity client for a while, and they had just been taking money out of the business, and their accountants, dinosaurs, as we used the term before, had just put it against the DLA. They were faced with an £80,000 tax bill as a surprise. They then had to, they phoned me to say, oh my God, we're going to have to sell one of the buy-to-lets to pay for this. And I went, hold on. Got in a proper tax accountant. And when they looked at it, they realized what they'd been doing. They then had to go back and within a time frame that they could refile the previous year's accounts, then file the accounts for the year that was going to cost them 80,000. And in the end, the 2 years ended up only costing them £24,000 across the whole lot. They then got all of this money as wages and dividends and the proper way of taking things out. Because a dividend rate, am I right in saying it's something like 7.5%?
They did increase them, was it a couple of years ago now? So the basic rate of dividends is 8.75%.
Okay, yeah.
So rather that, so people assume, I'm going to pay 20%. I'm a basic rate taxpayer. I'm going to pay 20% on it, and maybe some national insurance as well. It's only 8.75%. Even as a higher rate taxpayer, it's 33.75, so less than the 40. So you've hit the nail on the head there, and it is. Going back to the relationship, it's always about having that conversation with the accountant before you make a decision. Because it might be the case, I'm going to take an example where you'd like to be able to take the cash out of the business, and then you have the conversation with the tax accountant, and then they say, well, hold on a minute, but we're in March now. You want to take the money out now, but you've just told me that you're retiring in the next tax year. So why don't we wait until April when the new tax year starts, then take the dividend out, and you'll pay 8.75% on the dividend instead of 33.75. It's little things like that.
Yeah. So to summarize, and then I'm going to book some more time with you so that we can do the next one. This is top tax tips. Just that I'd say that I proved that I could say the title again. So what we've talked about is build a relationship with your accountant. They don't necessarily have to be your friend, but that you've got to have a relationship that you can speak to them and that they can speak back to you in a way that you understand. So you've got the whole relationship going on. Then my job as your client is to help you do your job better. Ask you questions, maintain good records. Don't do dodgy things like pay cash for stuff, or silly things, really. It could be dodgy, but it's also silly things like think that I'm saving money by paying cash for something when I should have paid VAT and you could have claimed it all back. But also maybe book in some conversations if you don't understand stuff about, if you like, almost the more strategic running of your business that says, okay, so the goal is to generate this much money. How can I then access that money in the best way possible for me to use? And you might say, oh, it's a director's loan, or you might say, actually, it's not a director's loan, it's paying back the director's loan. It's actually about dividends because now we've paid back the director's loan. You and the listeners' accountants are experts and professionals in your field, and our job as part of this relationship is to, with respect, draw out as much information from you as you can. Would you say that sort of like wraps up the top tax tips?
Indeed it is. Yes, perfect.
Well, brilliant. So look, as I said, I'm gonna stop this podcast now because it's been a big one. It's had a lot of information in it. Thank you so much for your time, Sean. I know how valuable it is. We're going to make sure that we put all the links to you in the business. Sean, as we said, is a very busy man, but you can still fill in the contact forms, and he's got people who work with him that could maybe help you. Make sure that you follow the podcast, because you don't want to miss out on the next episode that we're going to do, which is where we're really going to get into the meat of company versus personal. And this is such a hot topic at the moment in the property world. But in the meantime, thank you very much for your time, Sean.
My pleasure. Really enjoyed it. Thank you for inviting me.
Thank you.